What's going on, everybody? Welcome back. We're going to be going over model number 2 using our first presented fair value gap after 9:30. We're not going to waste any time. I would like to keep these somewhat short, under half an hour when I'm going over the model, and then the recaps kind of keep them around 15, 20 minutes. We're going to jump right into it. As you could see, I have some of the rules and pretty much what we're looking for. As I said, this whole series and lectures is how we're going to be using that first presented fair value gap. So I'm just drawing a little visual there, and how we're using it to grow from something like, I don't know, let's say we have a minute 15 fair value gap since that was our first model. We're using it to grow from something like this into something much bigger now, which could be previous day's high or previous day's low. Now, before we jump right into it, I am going to preface it this, right? So it's going to be a much bigger move. It's going to happen less. Okay, this is not something that'll happen every single day, nor will it always give you an opportunity. But as I said, we're going to use first presentation and we're going to graduate into these deeper, but more valid targets. You'll see the times that this is going to work out. It will be a straight clear shot run on a minute one from first presentation straight to previous day's high or low. That, like I said, that does not mean you'll always get an entry. That does not mean you will be able to find something every single day. I look for this and I've studied this. This is just what I do. And I've found a lot of repetition in, and I'm able to keep a really clean looking journal on based off of days of the week, specific dates of the month surrounding economic events that you could find all on Forex Factory, and mix up some other things. So we're going to jump into what those are. So first, I would like everyone, if they have not already, you should know some of the ICT daily templates. He's provided these. You go back, I believe it was in the core content months on his YouTube. Go back and reference all of these because this is kind of what I use in terms of, okay, it's like a Tuesday reversal, um, you know, Thursday high of the week type of idea. Like some sort of, it gives you some sort of framework, right? It'll help with this. So like I said, if you're looking at a Wednesday low of the week, you might be looking at Wednesday reversal on Tuesday. So it's going to take, it might take out Tuesday's low, or it might leave Tuesday's low and take it out on Monday. So having those templates kind of give you a raw footage, if you will, of what could happen. All right. So you're able to kind of anticipate this. So, and like I said, you also should have things, it'll all come to fruition when you have things like weekly analysis built. You're looking to see where could a weekly high or low be put in. And we could do all little exercises on that later down the road. But for the most part, right away in the beginning, you should be learning one-way directional order flow and how we could benefit while trying to be a trader. And this could work for any asset class. This could work for Forex. This could work for pretty much anything as long as you stay disciplined and study it enough on your own, right? Everyone, you shouldn't just be going by what I say. You shouldn't just be going by what ICT says. You should study it and go find the truth for yourself. So it starts with I'm marking the previous day's high or low. And like I said, if I'm looking for a Wednesday reversal, so ICT's taught us by Wednesday, that's when you typically see a higher low, one end of the range put in. I believe it was Wednesday's London session. So if that's deemed true, then you could think Monday could reflect off of Friday, or Tuesday could reflect off of Monday. Um, or obviously Wednesday could take out Tuesday's low and then create a reversal. But if it does, this is what we're going to be looking for. We're going to be looking for first presentation fair value gap after 9:30. This is a minute one gap. It cannot be 9:30. And this is all ICT's concepts and his principles. So all credit goes out to him for this. So I'm not here teaching first presentation. I'm teaching how I'm using it and how it's actually working out very well for me. So first presentation, fair value gap post 9:30. It cannot be 9:30's candle because 9:29 quote unquote doesn't exist if you look on the regular trading hours. So the earliest it could be is 9:31 using 9:30's opening price and candle. You're going to mark the first presentation gap, and then you're going to wait for it to close below. This says below first presentation gap in the direction of the previous day's higher low. So It needs to close above the first presentation if you're looking to take out a previous day's high. So if maybe you're putting in a high of the week or you're trading away from a high of the week, you want to see a close above first presentation's high. Vice versa, if you're looking to take out a low, a previous day's low, you're going to be looking for a close below first presentation. You're then going to be stalking M1 or minute one order flow. 15 seconds also allowed. I would study a minute one just because this will be a much bigger run. You should let the candles develop more. You'll see more liquidity runs on a 15-second than you would a 1 minute. So I would stay on a 1 minute. The ideal entry here is on the high or low. That is the target price. Okay. Now, why is it not 50%? Because you want that confirmation. It's closing, it's moving away. Okay. Your entry could look like a fair value gap that trades over it. It could look like an immediate rebalance back on that price. It could look like it just closes and wicks back on the top. Whatever that must be, that is it. You then want to see it respect the top half. You could move your stop loss below the low of it. And once it starts closing out and away, you can move your stop loss to the bottom half of that first presentation fair value gap. Partials and stop loss to break even once it hits minute 15 internal gap. So that's the model we just did. And this is why I told you we're going to graduate into these things. So you'll notice it'll go up and it'll hit those minute 15 gaps. That's when you want to be paying attention because if it's not going to work out in your desired direction, you can at least pull a partial off and have your stop loss to break even. You're going to notice in the example I'm about to show you, when they work out, it's a straight shot. There's no retracement, there's no return. It's just a clear straight run from that um right into the previous day's higher low. So let's jump into that and show what this really is. Okay. So I want to highlight this right here. We're going to talk about Friday, the 14th. Okay. So this is last Friday, and this is just, there hasn't been an example of it this week. It's only Tuesday. So I had to resort to using last week. I marked up the Thursday's high of the day, right? So 6 p.m. starts the new day. This was the high for Thursday. And you can notice we're now on Friday. Now, this is a validated setup in my opinion because what does Friday normally do? Okay. And I just want to share this was not taken. I did not take this. This is simply just a study. I was actually looking for it on NASDAQ and it just didn't perform as I wanted to see. Yeah, or correct that. I was looking, and you can go back, everything's time and date stamped. I was looking at Dow Jones because I did not like how ES kind of threw this wick off here. But I'm still going to show you what we could have actually done for that. So we will label this up in here, previous day's high. Okay. And just clean this up a little bit. All right. Now, first presentation occurs after 9:30. So where's 9:30's opening price? Right here. I don't I don't mark up this price. I just note where it is. I try and keep less things on my screen, but I'll note it here. And then first presentation, right? It can't be 9:30. There's no gaps, no gaps. The first one is right here at 9:35. Since there's no wick on 9:36, I'll just put it to that opening price and drag it across. So I want you guys to look at something here. And we're going to play a very fair advocate. So, let's see. I want to see if this doesn't mess things up really quick. All right. All right, so what I just marked up was a minute 5 gap. Okay. And our first model we'd gotten was first presentation into minute 5 or minute 15 inefficiencies. Internal. Okay, so that's the internal range. This is the easiest objective. Okay, and this will actually be labeled as blue, which will be okay. So that's first presentation. This is a minute 5 inefficiency. There's no minute 15 inefficiency. It's only a minute 5. You only use minute 5 and 15. That was all explained in model number 1, and or in the introduction. I may have went over that as well. I want you guys to notice this. It dove down into first presentation. It overlapped it. You always wait for to see what the first candle does. You don't just enter as soon as it hits it. I do not, at least. You'll see what the first candle does and react off the second. This one sliced and closed below it. Not what we want to see. With previous day's high in mind on a Friday, also expecting what's a Friday tendency to retrace back inside the range, which is the thank God it's Friday setup that ICT's made for everyone in that template, that you want to see a 20 to 30% retracement on the weekly candle. So if we're expecting that idea here, this was a bearish week, right? So now Friday is retracing back into its range. Now what happens, okay, when it cuts all the way below it, right? We're not taking, as you guys could see in the Telegram, when I have a level in mind, I'm not taking the opposite direction. I'll study it, but I won't take it. I won't trade it. So if, as I said, I was not watching this level last week. I had a different objective in mind that you guys could be in the Telegram about, but I still wanted to share this setup because this is actually pretty clean in terms of pure order flow, if you will. So first presentation, it cuts all the way through. It then closed back over the top. This is when we'd be studying an entry back onto here and then a run higher. Now it did not give me an entry here. I could jump into a 15-second and I will do it just for completion. Now the thing with the 15-second as well, this one did not come back to the high. If you want to feel impulsive and enter off this candle's open once you closed above, stop loss would have sat at the low and it would have gave you a run. Let's see. So it would have went to that target of 11 handles with a 5 handle stop. So a little 2 to 1 in there. Um, that could have been your setup, I guess. I probably would have waited to see if it filled that gap since it didn't touch back on the high. I like to see an immediate rebalance. I think that's a very strong one. Fair value gaps are fine as well, though. So then I want to go back out to a minute 1. So that you could consider that maybe stop back at break even, or you could even consider a loss if you're like, I would have left it there. I want to see it run all the way up. Sure. I'm now going to show you what happened when it came back. So it traded back down, no wick, right? So I want to kind of share this. Whenever you see reversals, you're always seeing wicks for the most part. I wouldn't trust that that is going to be a swing low in a reversal, nor is that a swing low because this candle poked below it, and then this one poked below that one. So you don't have a swing point. You don't even have a wick in this. It closed on a body. Price went up. It rolled right back inside. We need to see price close above it. It does that here. This looks like a nice order block to me. And look at how the bodies respect that top half, just as ICT's told us, just as we've watched. So if I'm watching order flow now, and I'm getting entries all up on here, a safe stop loss would be I would use below 50% of this. You have to accommodate for it wicking down here. If that stops you out in the wicking, that's pure manipulation that no one's going to be able to control. Okay? That's as flat as you want it. If you look at what the bodies tell you, that's a different story. So I've taught you guys when I'm watching order flow that I've once again learned under ICT's wing. When I'm watching order flow, I'm watching to see down close candles supporting all higher prices. So I will label them in, we'll go red. And look at how it's stacking. So when you have down close candles, you want to see a bullish candle close above it. Does it here? No. Does it here? No. Does this one close above that? Nope. Next down close candle, does this one close above it? Almost. This one closed above it, so boom. Does it now hold this candle? Yes, it does. That could be an entry right in here. Great entry, stop loss below this candle's low, which is also below first presentation. Look at that reaction now off 50%, and it's in a nice skyrocket up. It now closes right above 50%, so that's a good sign right in there. It's managed to go up and close inside of it. The next candle did not melt away from it. That's also a good sign, right? This versus closing now. It's showing you it's working inside of it, versus something stabbing, wicking, and then completely peeling away. You'll notice it'll tap it with like just like two wicks, like the tweezer bottoms, the retail patterns. No. So if you look at this, it's like I said, bullish order flow, gaps, right? So this gap right in here, supporting higher prices, this gap supporting the bodies, down close candle gets closed above, right? More down close candles, we're closing above them. So look at that order flow from first presentation straight up into previous day's high. Now let's say you got stopped out right in here once. Let's say you got stopped out right there once. Maybe you collected one partial and then it stopped you out. And you didn't listen to the rules and you didn't put stop loss back to break even because, like I said, when it wants to go, it goes. It doesn't come back. Let's say you got stopped out there. That's one loss. And let's say the wick got you out again in here. That's two losses. And then you finally got the one stop loss sat right below it. It took off right in your favor. Gave you a great run. Look at the time it got up there by. Nice, timely fashion right in the morning before the AM session's done. It all got, banged out in one shot. Look at this now. This ran for a 1 to 10. Um, and that's with two stop outs. And rightfully so, this should have been stop loss to break even. And the wicks you can't control. So if your stop loss did sit right at the low, you got wicked out a few times. Or actually, you'd realistically get wicked out once because it would have wicked you out here. You would have waited for your first down close candle to begin your order flow. And those are all aggressive entries too, just placing them right there with stop loss below it. I don't want to say a non-aggressive, but a safer entry is using order flow. It just grants you sometimes a lesser entry. It would be up in here. Now, that's not a bad thing, but for some people, there's a difference in, you know, the 3.5 handle stop loss versus, let's see what this one would have been, 4.5, almost 5. And then on top of that, now you're also 7 handles in profit, or you could have been 7 handles in profit where you're entering now. So those are all a couple things to keep in mind, but they are extremely large runs. You do not need a lot of these. These are the ones that, let's just say this, when you come in contact with these runs, you could stop trading usually for the week because it's a very nice trade. It could yield a lot, especially if you leave some runners on. And like I said, you should be able to safely use your stop loss and guide it right up into the target. So that being said, guys, this is model number 2. This is first presentation into previous day's high or low. I want you guys to go back and look at this on your own. I want you guys to study this, and you guys could see the potential of order flow between this level using with time on your side and how it creates order flow into levels like this. So if you guys like this video, you guys could give it a like. You guys could subscribe. It's all very much appreciated, and it's used to keep spitting out content like this. So, as always, leave some feedback, ask questions, and I hope you guys find a lot of luck with this model and it gets you on the right path.